A person needed $800 for a car repair. They took an emergency personal loan. 2 years later they had paid back over $1,400. The emergency ended 12 months ago. The profit on it continues to compound for another 12 after that. That is not a side effect of emergency lending. That is the product. There is a type of customer that financial institutions find extremely profitable, not the wealthy client with a diversified portfolio, not the business owner with multiple products and high balances. The most profitable customer for certain specific product lines is a person experiencing a financial emergency, someone who needs money now, who has limited alternatives, who cannot wait, who cannot negotiate, who will accept terms they would never accept if they had more options or more time. This customer profile is not an accident of the market. It is a target demographic that specific financial products were designed around. Overdraft fees, payday loans, emergency personal loans at high interest rates, penalty APRs that activate when payments are missed, late fees that compound into new balances. Each of these products is most valuable to the institution, selling it at the exact moment the customer has the least financial resilience. That timing is not coincidental. A financially resilient customer can shop around, wait, or decline. A financially distressed customer facing an immediate need with no alternatives cannot. The product that profits most from financial distress is designed, priced, and marketed specifically for the moment when you are least equipped to evaluate it clearly. By the end of this video, you will understand exactly how each of these products works, why they exist in their current form, and what you can build right now to ensure you are never in the position they were designed for. Let us start from the ground up. Let us go through the specific products and their actual cost mechanics. Start with overdraft fees. An overdraft occurs when you spend more than is available in your checking account. The standard overdraft fee at major traditional banks in recent years has been approximately $25 to $35 per incident, not per day, per transaction. A person whose account falls short by $20 on a Tuesday afternoon may trigger multiple separate overdraft fees if several small pending transactions clear simultaneously. A $5 coffee, a $12 lunch, a $15 pharmacy purchase, each clearing in the same overdraft window, could generate 3 separate fees. The person needed $20 of float. They paid $100 in fees. Now consider the annualized interest rate equivalent of a $35 fee on a $20 shortfall covered for 5 days. It runs into the thousands of percent annually. No other credit product is priced anywhere near this level. But because it is called a fee rather than interest, it escapes the rate disclosures required of consumer lending products. Now move to payday loans. A payday loan is a short-term loan, typically 2 weeks, with a flat fee charged on the amount borrowed. A typical fee structure charges $15 per $100 borrowed on a 2-week term. This translates to an annual percentage rate of approximately 390%. This number is required to be disclosed under the Truth in Lending Act. It is disclosed in fine print in a document signed during a moment of financial stress when the disclosed number is the least salient piece of information available to the borrower. Now consider emergency personal loans from online lenders serving borrowers who cannot access traditional bank credit. These products often carry annual percentage rates between 30 and 300%, depending on the borrower's credit profile. They are approved quickly. They are funded quickly. The speed is a feature that serves both the borrower's immediate need and the lender's interest in closing a transaction before the borrower has time to evaluate alternatives. Every one of these products is most profitable when the borrower has the fewest alternatives and the least time to think. That is not a coincidence of how credit markets work. It is the architecture of how these specific products were designed. Now let us move from emergency products to the penalty architecture built into standard financial products that most people already hold. Because you do not need to walk into a payday lender to encounter products designed to extract maximum value at moments of financial stress. Those products are in your existing credit card agreement, in your existing bank account terms, in your mortgage documents. Start with the penalty APR. Most credit cards have 2 interest rates. The standard purchase APR, typically between 18 and 28% at current levels. That applies to ongoing balances, and the penalty APR, typically between 29 and 30% or higher. That activates when a payment is missed or made late. The penalty APR can apply retroactively to your entire existing balance, not just future purchases. Every dollar you owe, at a higher rate, triggered by a single missed payment. This provision is disclosed in the cardholder agreement, a document typically between 20 and 30 pages long, written in dense legal language, provided at account opening and rarely reviewed afterward. The person most likely to miss a payment is a person experiencing financial stress. The penalty APR is specifically designed to activate at the exact moment financial stress is highest. A financially distressed cardholder is now paying a higher rate on a balance they were already struggling to manage. This is not an edge case. The Consumer Financial Protection Bureau has documented that penalty rates affect a significant portion of credit card accounts at any given time. Now consider late fees. A missed payment on a credit card typically generates a late fee between $25 and $40. If the late fee pushes the balance over the credit limit, an over-limit fee may also be triggered. If the minimum payment next month includes the original missed minimum plus the late fee, and the person cannot fully cover it, the next month's balance is higher before the new payment cycle begins. Each of these mechanisms compounds on each other. A single financially difficult month can trigger a cascade that takes multiple months to unwind, with fees and penalty rates accumulating throughout. Now consider the mortgage late payment structure. Mortgage servicers typically charge a late fee of 4 to 5% of the missed payment amount if payment is not received within a grace period, usually 10 to 15 days after the due date. On a $2,000 monthly mortgage payment, that is an $80 to $100 fee for a payment that was 11 days late rather than 9. The grace period is set where it is because the data on borrower behavior showed where the threshold of capturing maximum fee revenue sits relative to where most late payments fall. This is documented in internal pricing analysis that has occasionally become public through regulatory proceedings. The grace period is not set for the borrower's convenience. It is set for fee revenue optimization. Every penalty structure in every standard financial product you hold has been specifically calibrated for maximum revenue capture at the moment of customer stress. Not by accident, by analysis, by testing, by optimization. And it runs every month on tens of millions of accounts simultaneously, generating billions of dollars in revenue for institutions whose publicly stated purpose is to serve their customers. If the penalty architecture we just covered changed how you think about the terms buried in your existing accounts, stay with me. Because understanding how these products were built is one thing. Understanding why the regulatory history has allowed them to persist largely intact, and what you can actually build to make yourself an unattractive customer for these products, that is what comes next. Here is the regulatory history, worth understanding. Emergency and penalty financial products have been the subject of regulatory attention for decades. The Consumer Financial Protection Bureau, created in 2010, following the financial crisis, was specifically mandated to address predatory consumer financial products. In the years following its creation, the CFPB pursued regulatory action on overdraft fees, payday loans, and penalty structures with varying degrees of success. On overdraft fees specifically, the CFPB issued rules in recent years capping the overdraft fee that large banks could charge per incident, representing a significant reduction from the $35 standard. This rule faced legal challenges and industry opposition. The banking industry has consistently argued that overdraft coverage is a service with genuine value, allowing transactions to process that would otherwise be declined, and that fee revenue from overdraft funds the cost of providing this service. This is partially accurate. Overdraft coverage does have value for some customers in some situations. The question is whether the fee level is calibrated around the cost of providing that service or around the maximum revenue extractable from the customers most likely to trigger it. The evidence from internal bank documents that have become public through regulatory proceedings consistently suggests the latter. On payday loans, the CFPB attempted to implement ability to repay requirements that would require lenders to verify that borrowers could actually repay before issuing high-cost short-term loans. This rule was finalized, then partially rescinded, then revised across multiple regulatory cycles, with the pendulum of protection moving based on the political orientation of the administration in power at each point. The payday lending industry spent hundreds of millions of dollars in lobbying and legal challenges during this period. The consumer advocacy community spent substantially less. The outcome reflects that asymmetry. What currently exists is a patchwork of state-level regulation, some states with effective rate caps, others with minimal protection, and a federal regulatory environment that has shifted significantly based on the political priorities of successive administrations. The practical result is that high-cost emergency financial products remain widely available, widely used, and enormously profitable in most of the country, not because the harm they cause has not been documented. It has been documented extensively, but because the institutions profiting from them have consistently had more resources to defend the status quo than the population they affect has had to change it. That is the same sentence. This channel has arrived at in multiple different contexts across multiple different systems, because it is the same structural reality operating across all of them. Here is the most useful reframe in this entire video. The goal is not to understand these products so you can use them more wisely. The goal is to make yourself an unattractive customer for them entirely, because the best version of interacting with an emergency financial product is never needing one, and the mechanism for that is specific and buildable. First, emergency fund, 3 to 6 months of essential living expenses, held in a liquid, accessible, separate account, not invested, not locked up, immediately available. This single financial structure eliminates the primary use case for overdraft fees, payday loans, and emergency personal loans simultaneously. A person with a 3-month emergency fund does not need a $35 overdraft fee to cover a $20 shortfall. They transfer from savings. The fee does not occur. Second, small available credit buffer from a low-fee credit union or community bank that you never carry a balance on, used only in genuine emergencies, paid off in full within the same billing cycle wherever possible. This eliminates the penalty APR risk, because the penalty APR only activates when payments are missed. A zero balance requires no minimum payment and cannot trigger the penalty. Third, understanding the grace periods and automatic payment settings on every account you hold. Setting up automatic minimum payment coverage on credit cards ensures that even in a month where you forget or face cash flow issues, the minimum payment processes automatically, preventing the cascade of missed payment, fees, and penalty rates. This is a 5-minute setup that eliminates an entire category of penalty risk permanently. The products designed to profit from your financial emergencies require one thing to work. They require you to have a financial emergency with no alternative. Build the alternative. The products become irrelevant. Financial emergencies are real. The products designed around them are also real. And those products are not designed to get you through the emergency as cheaply as possible. They are designed to extract maximum revenue from the period when you have the least ability to push back. Understanding this does not change the emergency. Building the alternative does. An emergency fund, automatic payments, a low-cost credit buffer. 3 structures that make you an unattractive customer for the most profitable products in consumer finance. Share this with one person who has ever paid a fee during a difficult month that they felt was designed to punish them for struggling. Because it was. And if you want to keep understanding what the systems around you are actually designed to do, subscribe to Hidden Truth Files. Hidden no more.